Good day to you all. At this time, I wish to welcome you to our accounting class, Kings and Queens accounting class. We have started to look at the adjustments relating to final accounts. And in our previous lesson, we have addressed the matter in relation to depreciation, and we've also addressed the matter in relation to provision for bad debt and writing off of bad debt. In this lesson, we want to now bring your attention to accruals and prepayment expenses. Now, we will be seeking to do at least 2 other lessons relating to accruals and prepayment. This lesson is specifically to deal with how to treat with accruals and prepayment of expenses. So we're looking at the expense side of things in relation to accruals and prepayment. And then our next lesson, we'll be looking at accruals and prepayment relating to revenues. And then thirdly, we want to look at the final accounts, that is the income statement and the balance sheet, and how these items of accruals and prepayments are treated in the final accounts. So that is what we wish to do, to share with you so that you can have clarity in relation to the concepts that we are doing in adjustment of final accounts. So, ladies and gentlemen, today's lesson, we're looking at accruals and prepayment, as I said before, and objectives to guide our deliberation. We want to explain the concept relating to accruals and prepayments. We want to identify the basic accounting concept, yes, and we also want to treat the accruals and prepayment using the double entry principle. All right, let's get right into it. So now let's deal with the concept of accruals. Let's deal with that first. Accruals. Now this word accruals is also called, we also owings, and we may also see it as outstanding, or we may see it as arrears. So these are other classification of the same concept. Owings, outstanding, arrears are all the same relating to this concept across. So they are interchangeable names that is given. Now the intention of all businesses, yes, is to make sure that they are earning, they are making a profit. All right, and in order to make a profit, then they will have to determine the difference between their expenses and their revenue to get their profit. Now, from time to time, as the business is operating, they will have some challenge in covering all their expenses, yes, for the period within that period. Okay, and therefore you will find that there may be some expenses that are partly paid for, or some expenses that have not been paid for during the period, yes, and are carried forward into another period. Arising from that, ladies and gentlemen, an adjustment is required to make sure that the business is actually taking account, yes, taking account for the actual expenses for that period, to compare it with the actual revenue, so that they will have a more accurate information in relation to their net profit. You don't want to have a net profit that is inflated or understated, yes, so it will not give the business a true picture of what really is happening in their operation. So accruals is where now and expenses incurred, yes, and but you have not yet paid for all of it, yes. Let, for example, you are supposed to pay $100, yes, $100 for stationery, and you were unable to pay all of it. You have paid $80. Then you would have been owing $20, or it is accrued by $20. That's what the idea is about. Taking into consideration the proportion that is owing. Yes, that's what we refer to as accruals, outstanding, or arrears. Now, the other is prepayment. Now, prepayment is where you are prepaying ahead before you are using up that which that expense. So the prepayment is also referred to as advance. Yes, advance. So you are giving money for something for future use. Yes, you're paying money now for future use. That is the prepayment. Most persons who operate a car or some motor vehicle would always be doing some what I refer to as prepayment. For example, your insurance. When you pay for your insurance, you go to the government institution and you buy the insure. Sorry, you go to a insurance company and you buy an insurance for a year. So let's say that I go and buy the insurance for January and I'm paying for it for the year. Yes. So on that particular time when I'm buying it, all the months to the end, to December 31st, will be prepaid. In other words, I am paying them for insurance prior to me using up that insurance. Yes. So prepayment is taking place. Somebody has received, you give somebody a day work to do or some kind of casual work to do, somebody to mow your lawn, and they're going to come tomorrow to mow the lawn, and you have paid them today. Yes, you give them the money today. Therefore, you are making a prepayment. So you pay them today to do the job tomorrow. So the service is not yet done. Service will be done in the future, but you have paid them presently or paid them now. All right? That's what is referred to as prepayment or advance. All right? I want to move quickly to point out that objective, identify the basic accounting concept. Now, the principle are the accounting concepts and convention. These are some rules by the governing bodies of accounting have set out in which accountants need to follow. Principles and rules that you follow in doing accounting. And one of the accounting concept is what is called the accruals concept. Yes, the accruals concept. Now, the accruals concept really indicates, and I want to state it clearly here, the accrual concept, accruals concept indicates that revenues, yes, should be recognized. Revenue should be recognized as it is earned. So they say you must acknowledge and record, yes, revenues that are earned. The second concept in the accounting convention is that expenses, yes, expenses that is incurred should be charged or recorded. what are they saying in the accounting convention here? They are indicate that what they are saying is that you must take into account revenue once occur in the period in order to determine actual revenue. You must consider all revenues that take place within that period. All revenues that you earn within that particular period, you are going to match it against all expenses that are incurred for that same period. And that will, when you make that comparison, will give to the business owners a clear idea of their actual profit, right? So that is what the accounting concept is about, indicates that revenues should be recognized as it is earned, and that expenses, yes, that are incurred should be charged or recorded within that same period. So you're matching actual revenue with actual expenses, and that will give you a clear picture of your profit or loss. All right, let's move on quickly. Having said that, now we're going to go to objective number 3, which is treat accruals and prepayment, yes, using double entry principles. So let's deal with accruals now. Again, accruals or owing is treated as a liability. It's treated as a liability. Why? Because you are owing somebody or some institution. You are owing, and liability is really what the business owes, right? What you owe, okay? And because accrual of expenses, and we mean accruals here, we're talking about accruals of expenses. I want to be very specific. Accruals relating to expenses is a liability because you owe, you have used up the expense item, but you have not yet paid completely for it. So you owe the supplier. In some concept, they refer to as expense creditors are referred to as expense creditors, right? Accruals also referred to as expense creditors, right? You have trade creditors and expense creditors. So once you, for example, you have a water bill to pay. You have used the water for the particular month, yes, but you have not paid all of the bill, yes. So you are owing the company. So it's a liability. Now, a liability account, we had said in our previous lesson, is that it carries a credit balance. Carries a credit balance. So we're dealing with accruals relating to expenses. Yes, it is a liability. And to be more specific, a current liability. Yes, to be more specific, it is a current liability. So current liability. All right. Now, I want to move further to explain, because we're now going to look at the T account. All right. Double entry system. Now, let's take an expense. Let's take an expense. Let us say wages. All right. You are paying wages. So now, whenever we pay for expenses, yes, once we're paying expenses, we're going to debit. So whatever we paid, either by cash or by check, will be on the debit side. Okay. Now, if we are owing for the expense, if we are owing, this closing balance will be on the debit side. Balance and balance CD, and is referred to and most time written as accrued CD. yes, is written here. So this is the closing. This CD refers to closing. So this it's the closing balance. If at the so it is on the debit side. All right. Now, when we total, and let us make it a little bit more practical. So if this is $100 and the owing is 20, yes, total is going to be 120, and so we'll transfer to the income statement, yes, a total of 120, yes. So if the CD is on the debit side, the BD is going to be on the credit side. Accrued BD of 20. So you notice the opening balance is on the credit side because it is a liability, treated as a liability. Okay, so this is how it would look if you are going to be treating with accruals. Let me now do this exercise. If we come over here, well, a few exercises here. The first one, telephone bill paid in 2018 amounted to $600. The bill for November and December 2018 of 120 was not paid until 2019. All right, so let's deal with that now. So we're going to be opening the telephone account. And they're saying that we pay for a telephone bill for that year, we paid $600. Again, what did we say again? Once we're paying for expenses, yes, we're going to debit the expense account. So we're paying, let us say it is, let's use cash. And the amount is $600. Okay? Now they said to us that the bill for November and December, right? The bill for November and December in the same year was not paid until 2019. It was not paid until 2019. Yes? Which means that at the end of 2018, we are owing for telephone bill of 120. So we're going to have accrued CD of 120. Now, so the total telephone bill for the year of 2018 would have been $7,720. That is what we would have now put into our income statement. Why we have to charge $720? Because that's the actual expense that took place within the period of 2018. And what we said about the accounting concept, basic accounting concept, yes, and convention, is that we charge, yes, the actual expenses for that particular period. Irrespective of whether it is paid or unpaid, we charge that in that particular period. So, against our profit. So we're going to transfer to the income statement. Yes, we'll transfer the 720. So, 720, yes. And or once we have a CD, we must always carry over to BD, yes? We never leave it like that. So it's going to be accrued BD of 120. There you have it in relation to treating with a situation where there is a owing at the end of the period. Now, I want to do the second exercise. So let's go. Let me try to do it here. So we're doing rent account. the rent account. The question says that rent paid during 2017 was 1,000, yes, and 18. Owing as at December 31st, 2016 is 250. So during the year 2017 we pay 1,800. As at December 31st, 2016, we had an owing of 250. That means prior to 2017, we had some monies owing for rent, an amount of 250. So the opening accrued is going to be here. So it's going to be accrued, R-U-E-D, accrued brought forward, and the amount is 250. Okay, so the amount we paid, so this would have been what we start the period. The amount we paid during the year, so let's say we pay it by bank, by check, so it's bank, and it is 1,800. Yes, they also tell us that we also owe at the end of 2017 for 290. So we owed in 2016, that came over into 2017, so it becomes opening to 2017. All right, and at our close of 2017, we're still owing 290. So we're going to have accrued CD of 290. Yes. So now, we're going to add this, subtract it from this here to give us the amount to go to the income statement. The total here would be 0,902, 2,090, right? Okay. So, we now are going to subtract the 250 from this, yes, and that is going to give us the amount. So that would be now, that would be, so when we subtract the 250, yes, from the total of 2,090, we should get 1,840, right? If we add back the information, we should get it 0, 9, 8 plus 2 give us 10, so it's 0, carry the 2. So we double line this here to close and do it here. Our CD now with BD is accrued BD of 290. So we would have accomplished the exercise. So the opening accrued, or we owing, is a liability. We open it on the credit side, yes, and the closing is on the debit side. All right. When we are paying for expense, we are debiting, and the difference is going to go to the income statement. Others would refer to it as a profit and loss account. All right. So that is in relation to deal with accruals. Yes. How to do it in the double entry. I want to move quickly now to look at prepayment, an exercise for prepayment. Now, prepayment as an expense. Yes, prepayment. Yes, as prepayment expenses. I want to make it specific. This is a current asset. And we know that current asset carries what kind of balance now? A debit balance. Right? Current asset carries a debit balance. So prepayment of expenses is a current asset. All right. Now let's open an account. And I'm going to show you quickly. Now, let's say we're dealing with let's use commission. All right. Let's use salaries. Salaries account. We're dealing with expenses here. Salaries. So now, in our salaries account, the opening prepayment, since it's an asset, a current asset carry debit balance, the opening prepayment will be on the debit side. So you have prepaid brought down, right? And if the prepaid brought down is on the debit side, the CD is going to be on the credit side. Prepaid carry down. Okay. Now, when we're paying for expenses, again, we said before, we're always going to be on the debit side, so we pay by bank or in the form of a check. Okay. Now, the amount to be transferred to the income statement or the trading profit and loss account. The profit and loss account will be written here. Income statement, and it will be written here. Add this, subtract from this to get this. Alright? So, to make it a little bit more clear, let's put some figures into it. So we have 100 here, and we have 1,000 here, and we have 50 here. Okay. Now this is going to be 1,100, right? If we take 50 from it, it's going to give us 1,050. So it's going to be 1100. Okay, and then this CD comes over here as prepaid rather, brought down of 50. Okay, that's the idea. So when you're dealing with prepayment in relation to expenses, prepayment of expenses, they are current assets. Yes, so they carry a debit balance, right? Assets normally carry debit balance. Means what we mean is that the first entry being made in any asset account is always going to be on the debit side. So salary, if we prepay, where the prepayment still coming into the new year, where the prepayment, the opening prepayment will be on the debit side because it's an asset. The closing prepayment is going to be on the credit side. Yes. The amount paid during the year for salary, again, once you are paying for expense, it's always going to be recorded on the debit side. So we made the entry on the debit side. The difference between the total here and this will give us the amount to go to the profit and loss or the income statement. I have an exercise to close out this one. Insurance paid in 2019, 420. Yes. Prepaid as at December 2019 is 35. So let's look at how that would feature here. So we open the T account and we're dealing with insurance, so that's the name, insurance account. All right. It says that we paid for insurance for 2019. So in 2019, so let's say bank, or we could say cash, whichever, at 420. Okay. And it says at the end of 2019, we have made a prepayment. So the prepayment, closing prepayment is going to be on this side. See? Closing prepayment. So prepaid CD is 35. Now, the total that we take down would be 420. When we subtract 35 from 420, that is going to be the amount that would go to the income statement or the profit and loss. All right, that's what is going to be happening. Okay, so when we subtract 35 from 420, we should get, what is it again? 385. 385. But to make sure our math is right, 5 plus 5 equals 0. 8 plus 4 is 12. And we take 1 here, that's 4. Okay, we're good. So a double line. And because it is prepaid CD, we must have prepaid BD of 35 here. And that would be how to treat with it with the prepayment of expense using the double entry system. I hope that we have made it clear to you in relation to accruals and prepayment. All right. Prepayment of expense is a current asset as against accruals of expense. They are current liability. All right. And if they are current liability, they are liability, then carries credit balance in the T account. If they are assets, the prepayment asset is going to be carrying a debit balance. All right. We thank you very much for sharing with us, and see you over on the other side when we look at the other concept, that is accruals and prepayment, treating with revenue. Thank you very much. If you like this video and this class, please click below. And if you have not yet subscribed, click the subscribe button so that you can get the other lessons that are coming. Thank you very much. God bless.